Guys are having a great day today. Good morning, good afternoon, good evening, wherever you're at, wherever you're watching this at. Um, I'm gonna make a quick little video just about my opinions on with income and growth investing. Okay. Um, and this is not financial advice. I don't know a lot, I just know a little bit. My goal is simply just to document my investing journey, share my opinions, things I learn, and just grow with y'all. So here we go. All right, so the income investing, I'm specifically talking about your high yield dividend paying ETFs and other funds. Um, the pros to that, and why I think that you guys should look into these if you haven't already, is they're going to pay you consistent cash flow from these dividends. If it's every week or every month, they're going to pay you some cash flow. They're going to write you a little check every week or whenever they make the distribution, and it's going to help you either reinvest or pay your living expenses. Okay. So the lower volatility and steadier returns. So the steadier returns, like they're not the exact same. They are going to vary week to week, but relative. Oh snap! Sorry. Okay. They're gonna vary week to week. However, they're pretty consistent, right? Lower volatility. I say lower volatility because they, if the overall market is bearish, if we're in a correction, then what we can do is reinvest those dividends just to help kind of offset the losses. Okay. Um, so great for reinvesting or covering expenses. That's pretty simple. The cons is slower capital appreciation. Actually, in fact, most of these funds really don't even appreciate. They're pretty much staying flat because their profits are being given to us every week or month. But weeks week is where it's at. The dividends may be taxed. However, depending on what they're paying out, some of the distribution is return of capital, which is not taxed. So that's pretty good. That's gonna help when tax time comes and you gotta pay the IRS or the if you're like in Canada, I don't know if it's called the IRS, but at least in the US, that's gonna help with that. And risk of dividend cuts, I mean, this is just kind of like the dividends aren't the same. So like, you know, let's just say this week they're paying out 20 cents a share. Next week it could be 16 cents a share, just for example, right? So they're not like the exact same every week, but they are still pretty consistent. So growth investing. This is going to be if you're investing in things like VTI, VOO, SPY, QQQ, just long term capital appreciation funds, stocks, ETFs, whatever that may be. The pros, you're going to get higher long term upside potential, and you're not going to pay taxes until you sell the asset. And as long as you dollar cost average into them, if it's $5 a month, $50 a month, 10 or $100 a month, you can really get some strong compounding over time. Um, as long as you let it sit and just mature for the next decade or 2 decades or longer. The cons is you can get more price volatility just depending on what the market's doing. If the market's in a recession or if we're in a pullback, um, then you're gonna, potentially lose some money or lose some money. Yeah. But you don't really lose money until you sell. So just don't sell and just stay in there and just keep dollar cost averaging. And then with these growth funds, not all of them, but some of them, they're not going to pay you regular income because they're growth. Unless if like some of them they pay out a dividend like SCHD, they pay out like a 3% yield. So they're like they do have a dividend, but it's 3%. And but they do get capital appreciation, which is also nice. And then so what I like to do and what I would advise others to do is to combine both into your portfolio. So if you do this, then you're going to get the power of growth and you're going to get that cash flow every week. What's going to do is it's going to create a long-term strategy by your growth investing option. It's going to build your wealth by increasing the value of your portfolio, while your income funds are just going to generate you cash flow that pay you consistently. And simply, I mean, like when you combine them two, you're going to get portfolio growth over time and also reliable income that you can reinvest back into the fund or you can use for your monthly expenses. You're going to get lower volatility during market swings because if, like I said earlier, if we're in a pullback or a recession or whatever, you can just reinvest those dividends back into the funds. And you can get faster compounding if you reinvest the dividend or if you just keep dollar cost averaging. So, my takeaway is that the growth is going to build your portfolio engine and then your cash flow assets are going to fuel it. So the strategy allows you to grow wealth and generate cash flow at the same time. So thanks, y'all. Um, if y'all have any questions, comment down below and I can get to them. But until then, until the next video, peace out.